I wanted to take a few minutes and share some of my thoughts as to what's currently happening in the world economy. I won't be using any charts or graphs this time. This will simply be a verbal discussion. In my industry, I'm seeing some harbingers of very bad times on the way. My industry is in the chemical sector, and my company produces feedstocks, which are very important in the production of steel, glass, cement, liquid fuels, plastics, fertilizers, food and beverage, non-ferrous metals, and pulp and paper, to name a few. In a way, you could say that I get a front row seat when it comes to seeing what's going on in the world manufacturing space. Almost all manufacturing sectors have seen very large declines in demand over the past year, and the trend appears to be accelerating. This is not simply happening in one specific geography. It appears to be happening in them all, and in particular, South America and Asia. As a reflection of crumbling demand, raw material prices have crashed. Items such as oil, steel, iron ore, cement, and natural gas are more than 50% below their 10-year highs, measured in dollars. The leaders I've spoken to inside and outside of my industry are all expressing alarm, and the vast majority of them can't really piece it all together and understand what lies at the root of the problem. Most are concerned about year-over-year earnings. After all, shareholders have become accustomed to strong and steady earnings growth. Some are even concerned about solvency. After all, when debt service payments are high, revenue needs to be much higher to pay the debt and still have enough left over to cover maintenance of building, ground, plant and equipment, and still make payroll. Which is one of the reasons why so many companies have had significant layoffs recently, and will likely continue to lay off more over the coming year. If you're in a position where you've lost your job, you have my deepest condolences. Believe me, almost all managers that I've known die a little on the inside when they're instructed to reduce headcount. You probably don't know this about your management team, but many of them care deeply about you. They are in a position where they have to bottle up their emotions when bad situations arise, but most of them are good people who work very hard to keep their people employed. So, if you're still employed, you might think about thanking your manager sometime. I bet he or she could probably really use a message of gratitude, especially right now. So how did we get here? What's really going on? I've made countless videos on the subject. Not everyone is going to have time to review them all, but they are all there for anyone who wants to. One in particular, The Process of Capital Destruction, released a little over a year ago, talked about what I thought at the time was likely to happen in the fracking industry as a result of all of the capital investments being made and the fact that the debt would need to be serviced by continuing to pump ever-cheapening oil. Sure enough, the process set in place did its damage, and it is continuing to do damage. What we are likely getting started on a worldwide scale has at its core the same root cause. We should talk about that root cause because it is the key to understanding what lies ahead of us. What it really is a crisis of realization. But what do I mean by this? Let me explain by asking you to divide all of the items in the world into two categories: consumption goods and everything else. A consumption good is necessary for you to live your life, or it's something that you use simply because you enjoy it. In the process of using it, you destroy its value over a fairly short time span of a few years or less. Food is certainly an item that would fit into this category. Clothing would also fit into this category. Electronic devices, such as iPads or TVs, also fit, as does the gasoline that you use to fuel your car. Your car is also a consumption good, because as you use it, it wears out quickly. Without frequent maintenance, it would be useless within the span of a few years at most. Even your house is a consumption good. Sure, it might last you a lifetime, but over that lifetime, things wear out and you'll need to end up spending significant funds to make repairs. Let's put everything else into another category: Items that don't really fit into the category of consumption goods are stocks, bonds, jewelry, art, gold, and silver, and land. And there are many other things that could fit into this category, but there are a whole host of items that people tend to own that are not really consumption goods. And these are items that people tend to amass. These are the things that people tend to store and count as their wealth. The reason? Because they can be held for a long period of time and sold later, so that consumption goods can be purchased with the proceeds. In other words, people hold these items because they believe these items can carry their purchasing power into the future. So we might call these things deferred consumption goods, or maybe wealth goods. In the past, people have used all of these items, some more successfully than others, for this very purpose. Now let's divide the world into two groups of people. On one side, we have people who are capable of producing. They are of working age and are in good health. Some of them have finely developed skills. Some have brilliant minds. Some simply have a good work ethic and a strong back. These are the people who produce consumption goods, and with the exception of land, they produce wealth goods as well. Then there are the non-producers. The non-producers consist mostly of people who are not yet of working age, and also of people who have spent a long career working and producing, but are no longer able to produce. Some are infirmed. Some simply feel like they've worked long enough and are ready to live off of the wealth that they amassed in the form of stocks, bonds, jewelry, gold, silver, art, and land. We know that regardless of what category people are in, producer or non-producer, all of them will require consumption goods. Thus, the producer group must be capable of producing enough for everyone. They produce an excess over and above what they need to consume or want to consume. The excess production will typically be used to buy some stocks, some bonds, jewelry, gold, silver, art, and land from the non-producer group. So we can see that we have a delicate balancing act. Consumption of the products of the producer class will exactly equal production. It cannot be any other way. If more consumption goods were made than needed, they would quickly wear out and become worthless. If fewer consumption goods were made, then people would simply need to do without. In order for this whole arrangement to work, at least on a voluntary basis, there is a certain amount of desire and faith required on the part of the producers. They have to value the wealth goods highly enough to motivate them to produce in excess of their immediate needs, and take wealth goods in trade for their excess production. They have to believe that producing more than they need is a worthwhile endeavor, and have faith that the wealth goods that they buy now will provide them with at least enough consumption goods later as they part with in the present. And they always have a choice of which type of wealth good that they want to take in exchange, ordinarily coming down to a decision of which one they think has the most promise of delivering to them a happy future. Every individual, whether producer or non-producer, has in his or her mind an idea of the value of these wealth goods. Each person will have a different opinion, and it is highly subjective. They will always be able to see items trading on the open market at certain prices. By referencing their own personal opinion of value against market prices, they determine how favorably valued various wealth items are priced, and thus the promise each has for preserving and building wealth in the future. These discrepancies are what makes for a market. Unfortunately for all those who hold any wealth asset, be it stocks, bonds, land, gold, silver, art, or what have you, there is really no precise way of knowing the value that a future generation of producers will place on any of these assets. The best that can be done is to estimate a value based upon a little math and some good rules of thumb. It is only when the wealth goods are used to obtain production goods that the truth is revealed. Each individual in a capitalist society takes it upon themselves to make sure that when the time comes, they have enough wealth assets to purchase the consumption goods that they will need, should they not be able to work. Sometimes individuals are quite successful in this endeavor. Sometimes they are quite unfortunate. It's usually shortly before the consumption goods are needed that the individual will know how well he or she has done, which occasionally leads to a personal crisis if the market tells them that they were wrong in their opinions of value. This is a crisis of realization, where the individual realizes that their wealth assets are not worth what they thought they were. The crisis can come in many forms and flavors. Maybe the individual had a portfolio of stocks and found shortly before retirement age, after a significant market decline, that the pool of producers values his shares at half of what he thought they were worth. Argue as he might about the reasons why they should be more valuable, he only has one choice. Either take what's offered and live more simply, or delay retirement. Then there is the individual who bought bonds in the hopes that between interest and principal payments, her bond holdings could be used to fund a comfortable retirement. But then shortly before retirement, interest rates declined to be well below where she thought that they should be. Again, argue as she might that interest rates ought to be higher, she will eventually come to accept that she has no options but to accept what is offered. It will be a painful adjustment process, this crisis of realization, but it is an adjustment process that will eventually happen. Gold and silver buyers face the same issue. And what can happen on an individual level can also happen on a mass level. Let's talk briefly about the period of time leading to the Great Depression and the Great Depression itself. According to the historical record, from the year 1900 to 1929, the general price level of goods and services more than doubled. These 3 decades saw prices increase by about 2.5% per year, all of the while we were on a gold standard. Those who held gold or cash outside of the banking system would have seen their savings devalued by 50% over the course of these 3 decades. Why is this? The government had set the value of the dollar in terms of gold and made dollars completely convertible. So why the decline in value? It all had to do with the expansion of credit. Between government borrowing to fund World War I, business borrowing to fund investment in plant and equipment, and personal borrowing to fund consumption, the supply of credit as measured by M2 money supply climbed from $10 billion to $65 billion. Whether the gold owner liked it or not, the newly created credit spent just like gold did, and all of the demand that it placed on consumption goods drove prices up. For the population of gold and cash holders, this was a crisis of sorts, and it should also serve as an illustration to those who want to stabilize prices by going back to a gold standard that gold alone will not do the trick. Somehow, a limit needs to be placed on credit creation. But after 1929, there was another crisis of realization. Those who had extended all of this credit came to realize that it could not possibly be honored. There simply was not enough specie in the banks to honor redemptions. This ultimately created a bank panic, which was really simply a crisis of realization on a mass basis. From 1929 to 1933, credit contracted by 30%, which was a 9% per year contraction. Prices declined by a similar amount, as those who held real money found out that they could buy much more than it could at the beginning of this period of time. So the turmoil around the Great Depression was really a crisis of realization. Those who had extended credit in the early 20th century in the hopes that the credit would serve as their wealth came to the realization, as the 1930s approached, that the credit was not worth what they had thought, and this created quite a panic. But would it be true to say that the credit went bad all of a sudden in the year 1929? No. The credit was bad when it was extended in the first place. What happened in the year 1929 was that the holders of the credit could no longer pretend that it was all good. Of course, those who had the power worked with the government and the Federal Reserve to preserve the illusion. When a bank holiday was declared, all of the gold called in, and the dollar redefined as 1/35th of an ounce of gold instead of 1/20th of an ounce of gold, it was like this picture of Dorian Gray, shown here, where a painting was used to capture and hide all of the flaws so that people could keep on pretending that the bonds were still worth what their owners had been pretending that they were worth. It's important to emphasize this once again. The credit was bad from the very beginning. Government and the Federal Reserve System were not able to prevent it from failing, nor were they able to ultimately force the bonds to be valuable. All they could do was move the consequences of the realization of failure from the rich to the masses. In other words, the losses were socialized. So what does this have to do with today? Well, we're facing the same crisis of realization on a much larger scale. I already discussed in another video the problem of the credit that was extended to the fracking industry for building all of the infrastructure needed to extract oil from rock formations. The credit was bad from the very beginning. Now we have an entire industry that must continue to produce more oil than the economy is prepared to absorb so that it can simply make interest payments on all of the debt that it took on. It has no hope of paying the principal payments that will be coming due on the bonds in a few years. The bonds themselves are not worth nearly what investors thought that they would be worth when they extended the credit in the first place. Just like in the shale industry, we have overinvestment in almost every other segment of the economy. Look at China with their very modern but underutilized highway system and cities that are barely occupied. There were those who wanted to lend them the capital to build all of that infrastructure. The extenders of the credit needed a place to store their wealth, and for a long time they enjoyed the illusion that they owned very valuable shares in businesses and bonds that would pay them handsomely over time. But the debt and equity offerings were dubious from the very beginning. The recent halting of the Chinese stock exchange twice in 1 week is a sign that confidence is starting to crack. There is a crisis of realization just beginning. And what of the U.S. stock market? It's declined by only 8% so far this year, and all I see are story after story explaining that there is no reason for the stock market to have declined by even this much. Truth be told, I'm surprised that the market has risen to the heights that it has. It is still 180% higher than it was when the true value of U.S. companies was almost realized in 2009. Because of the cheap cost of financing leading to stock buybacks, stocks are now more undercapitalized than they were in the year 2009. Revenues are falling, but debt loads are still very high. Yes, it is true that interest payments are lower than they were before, but just as is the case with the shale oil industry, there will be principal payments that will eventually need to be made. Unless somehow investors are willing to provide the necessary funds to allow these companies to roll their debt over when the principal comes due, there is likely going to be a very large string of bankruptcies. This will be bad for stock and bondholders alike. Sure, there may be those who want to keep the illusion alive. Perhaps some investors with lots of cash to burn will provide the funds needed for these companies to roll over the debt. Perhaps the funds will come from the Federal Reserve. Regardless, it will not make the credit good. All it will do is delay the crisis of realization. One of the biggest problems that we are facing right now is the plight of the baby boomers. An entire generation put their faith in Social Security, pension funds, stocks, and bonds. For a long time, Social Security took in more cash than it paid out. The government spent the money and created what it called a trust fund that it filled with treasury bonds. As more and more boomers have started to retire, the Social Security surplus has turned into a deficit, and the system is now starting to pay out more than it's taking in. As the entire generation of boomers enters retirement, will the funds be available to honor the obligations that were made? Only if there is a buyer for all the treasuries in the trust fund. Maybe the Federal Reserve will come to the rescue, but as Alan Greenspan admitted, the Federal Reserve can only help to make sure that the payments can be made in nominal terms. They cannot guarantee the purchasing power of the payments. This is simply an acknowledgement that in the real world, there have to be enough people working to create enough consumption goods to go around. It doesn't matter how much the savers think their savings should be worth. When all of the illusory wealth bids for real goods and services, we will find out just how much the savings are really worth, and the crisis of realization will be upon us. Pensions are in the same situation. For years, the regulatory agencies have allowed pension funds to assume an 8% return on the assets that they hold. Are 8% returns even possible in a world where interest rates on treasury bonds are only a couple of %? The short answer is no. As a consequence, the pension funds are in trouble. Kentucky, for example, is less than 20% funded. Will the pension funds be able to make good on their obligations? No. But that doesn't stop people from pretending in the meantime. Speaking of pretending, the regulatory agencies do not require the financial houses to mark their derivatives holdings to market. The balance sheets investors see are not even real. The executives of the financial companies are allowed to assign values to derivative investments, which are nothing but opinion. Nobody knows how much the derivatives books are really worth. It's a problem of huge magnitude, especially now that derivatives have been given seniority over other debt instruments and even deposits. So it's a problem of huge magnitude, and one where we know that we are pretending. We won't have a crisis of realization until someone calls on the derivatives holdings to perform. We've come close when small countries such as Greece and Puerto Rico were not able to honor their debts. Credit default obligations should have been triggered. However, you'll notice that the ISDA has done their best to avoid using language that would require these derivatives to perform. The problems that the global economy faces right now are all rooted in a single cause. And that is, for years, the excess production of the world has been used to bid up the price of wealth goods, mostly stocks and bonds. The value assigned to all of these wealth goods is a pretend number. We've been pretending for years that the mountain of debt and equities can be exercised to buy $300 trillion worth of goods and services. We've also pretended for years that the mountain of derivatives can be exercised to buy close to $1 quadrillion worth of goods and services. But we all know that this cannot be true. But that doesn't stop us from pretending. Fortunately, the illusion does not have to crack until those who own these assets decide that they want to try to cash in. That hasn't happened yet. But we do have an aging population, and those who are preparing to enter into the non-producer group will need to put food on the table, buy clothes, obtain medical help, and heat their homes. As this happens, we will get a chance to see the real Dorian Gray. And we will also see a world where the general living standards will not be what we've been pretending that they should be.